What does the Federal Reserve's latest decision on rate cuts mean for the economy? This is a question that's likely on many minds as we unpack the Fed's recent announcement. The Federal Reserve has decided to hold off on any rate cuts until inflation shows further signs of moderation. This decision may seem a bit cautious, but it's a calculated move made in the midst of a global economic slowdown and ongoing trade tensions. The Fed is keeping a keen eye on these variables, striving to strike a balance between promoting economic growth and controlling inflation. This decision, while seemingly conservative, is a reflection of the Fed's commitment to economic stability. So, as the world watches and waits, the Federal Reserve continues its careful dance with interest rates, a dance that could have significant implications for the economy. Stay tuned as we delve deeper into the implications of this decision. To understand the impact of this decision, we must first understand the role of the Federal Reserve and interest rates in the economy. The Federal Reserve, often simply referred to as the Fed, is the central banking system of the United States. Its primary role is to regulate the nation's monetary policy, striving to achieve maximum employment, stable prices, and moderate long-term interest rates. Interest rates are a key tool in this mission. They're like the accelerator and brake pedals for the economy. When the Fed lowers interest rates, it's like stepping on the gas. It stimulates borrowing, investing, and spending, thus driving economic growth. Conversely, when the Fed raises interest rates, it's akin to applying the brakes. It slows borrowing and spending, cooling off an overheating economy and keeping inflation in check. Now, let's delve into the Fed's recent decision. The minutes from their latest meeting reveal that they have taken a cautious stance. They've decided not to cut interest rates until inflation moderates further. This decision indicates their commitment to balancing the twin goals of supporting economic growth and controlling inflation. But what does this mean for the economy? Firstly, by not cutting rates, the Fed is signaling that it does not see an immediate need to stimulate the economy. This suggests that they believe the economy is performing adequately without additional monetary stimulus. It's like a driver who's content with the current speed and doesn't feel the need to step on the gas. Secondly, the Fed's decision is also a response to the current inflation scenario. Inflation, in simple terms, is the rate at which the general level of prices for goods and services is rising. Moderate inflation is actually healthy for the economy. However, if inflation gets too high, it erodes purchasing power and can lead to economic instability. By holding off on rate cuts, the Fed is expressing its intent to keep inflation in check. So what are the implications of this decision? For consumers and businesses, the cost of borrowing will remain the same, at least for now. This means that the cost of mortgages, auto loans, and other forms of credit won't decrease. However, it also means that the returns on savings accounts and other interest-earning investments won't fall either. For investors, the decision might signal a stable economic environment, which could boost confidence in the markets. However, some may be disappointed by the lack of a rate cut, as it would have potentially increased borrowing and spending, thereby boosting corporate profits. With this understanding, we can now explore the potential consequences of the Federal Reserve's decision. How might this decision affect the average consumer and businesses? This is the question on everyone's lips as we delve into the potential implications of the Federal Reserve's decision to withhold rate cuts until inflation moderates further. First, let's consider consumer spending. It's no secret that interest rates influence how much people are willing to spend. When interest rates are high, borrowing becomes more expensive, and people tend to tighten their purse strings. Now, with the Federal Reserve's decision to hold off on rate cuts, consumers may be less inclined to make big purchases, such as homes or cars, which often require loans. This could lead to a decrease in consumer spending, which in turn could slow economic growth. Next, we must consider the impact on borrowing costs. Higher interest rates mean higher borrowing costs. This applies to both consumers and businesses. For consumers, this could mean higher costs for things like mortgages and car loans. For businesses, it could mean higher costs for loans used to fund expansion and growth. Therefore, the decision to withhold rate cuts could lead to increased financial strain for both individuals and businesses. Now let's turn our attention to business investment. Businesses often rely on loans to fund investments in things like new equipment or research and development. Higher interest rates make these investments more expensive. So the decision to hold off on rate cuts could lead to a decrease in business investment, which could stifle innovation and growth. But what about those with variable rate debts and savings? Well, for those with variable rate debts, higher interest rates mean higher debt payments. This could lead to increased financial strain and potentially even higher levels of debt. On the other hand, those with savings could see an increase in the amount of interest they earn. However, this benefit could be offset by the potential increase in the cost of living due to inflation. In conclusion, the Federal Reserve's decision to withhold rate cuts until inflation moderates further could have significant implications for consumers and businesses. It could lead to decreased consumer spending, increased borrowing costs, and decreased business investment. Furthermore, it could have mixed effects on those with variable rate debts and savings. The decision has far-reaching implications, affecting not only the economy but also individuals and businesses. While the Federal Reserve's primary goal is to ensure economic stability, it's clear that their decisions can have a profound impact on our everyday lives. As we move forward, it will be important to keep a close eye on inflation rates and the actions of the Federal Reserve. Their decisions will continue to shape our economy and our lives in the months and years to come. What has been the response from investors and economists? Investors and economists have been closely watching the Federal Reserve's decision. Upon the release of the minutes, the reactions were mixed and echoed the cautious tone of the Federal Reserve. Investors, for instance, reacted immediately, with stock indexes dipping slightly after the minutes were published. The bond yields also rose a notch, indicating that investors may be expecting higher interest rates in the future. Economists, on the other hand, have been dissecting the minutes, trying to understand the implications for the broader economy. Some economists believe that the Federal Reserve's cautious stance is justified, considering the current economic climate. They argue that the Federal Reserve is right in waiting for more evidence of sustained growth before deciding on any rate cuts. However, there are differing views within the economic community. Some economists feel that the Federal Reserve is being too cautious and should consider rate cuts sooner to stimulate economic growth. These economists argue that waiting for inflation to moderate further could slow down economic recovery. There's also a group of economists who believe that the Federal Reserve's decision is a clear signal that the central bank is prepared for a potential economic slowdown. They argue that by keeping interest rates steady, the Federal Reserve is trying to build a buffer against any future economic shocks. Investors and economists are also intrigued by the Federal Reserve's discussions on its balance sheet. The central bank's indication that it may slow down the pace of reductions to its holdings of treasury debt and mortgage-backed securities has sparked a lively debate among economists and investors about the implications for the economy. As we move forward, investors and economists will be keeping a watchful eye on the Federal Reserve's actions. They will be looking for signs of changes in the central bank's stance on interest rates and its approach to managing its balance sheet. As we can see, opinions vary, but the common thread is a keen interest in the Federal Reserve's next moves. What could we expect moving forward? That's the question on everyone's mind as they digest the latest Federal Reserve minutes. With no rate cuts in sight until inflation moderates further, the economic landscape is set for some interesting developments. The Federal Reserve is currently walking a tightrope, balancing the need to support economic growth and keep inflation in check. They have made it clear that any future rate cuts will be dependent on the moderation of inflation. But what does this mean for the economy at large? Let's take a closer look. First, we need to understand that the Federal Reserve uses the federal funds rate as a tool to control inflation. When inflation is high, the Fed may increase the interest rate to slow down the economy and reduce inflation. On the other hand, when inflation is low, the Fed may cut the interest rate to stimulate the economy and increase inflation. Currently, the Fed is holding steady, waiting for more evidence that inflation is trending lower. They are not ready to cut rates just yet. However, they have also stated that they do not expect the rates to go higher in this economic cycle. This indicates a cautious approach, a wait-and-see strategy, if you will. So what potential future moves could the Federal Reserve make based on these economic indicators? Well, if we see a sustained decrease in inflation, the Fed could potentially cut interest rates. This move would stimulate economic growth by making borrowing cheaper for consumers and businesses. However, if inflation remains stubbornly high, the Fed may choose to hold steady, maintaining the current rate. The Fed is also considering a potential slowing of the pace of reductions to the central bank's holdings of treasury debt and mortgage-backed securities. This move won't be linked to a decision on interest rate decreases, but it indicates a shift in their strategy. It's also important to note that the Federal Reserve's decisions don't happen in a vacuum. They are influenced by a myriad of factors including global economic trends, political developments, and financial market dynamics. Therefore, their future actions will also depend on how these factors evolve. For instance, if global economic growth slows down, or if trade tensions escalate, the Fed might feel the pressure to cut rates to support the economy. Conversely, if the economy shows signs of robust growth, the Fed might decide to hold off on rate cuts. The importance of monitoring inflation levels cannot be overstated. Inflation is a key indicator of economic health. Too high, and it erodes purchasing power, creating a cost of living issue. Too low, and it could signal a stagnating economy. The Fed's primary goal is to maintain a steady, moderate level of inflation around 2%. Potential triggers for rate cuts could be a sustained decrease in inflation, a slowdown in economic growth, or an increase in unemployment. Each of these scenarios would signal that the economy needs a boost, prompting the Fed to lower interest rates. In conclusion, the Federal Reserve's future moves will depend on a complex interplay of economic indicators, global trends, and domestic issues. With their cautious approach, they are demonstrating a commitment to making careful, informed decisions that will best support the health and growth of the economy. Only time will tell what the future holds, but one thing is certain: the world will be watching the Federal Reserve's next moves closely. To recap, the Federal Reserve's decision to hold off on rate cuts until inflation moderates has wide-ranging implications. The minutes from the Fed's recent meeting reveal a cautionary stance, with an emphasis on the need for evidence of inflation moving sustainably toward 2% before any rate cuts are considered. This reflects a delicate balance the Fed is trying to maintain between fostering economic growth and keeping inflation under control. The Fed's decision not to cut rates has been influenced by a multitude of factors, including concerns about slowing global growth, ongoing trade tensions, and the need to closely monitor economic indicators. This approach has been described as wait and see, as the Fed is keen on ensuring sustained growth before making any changes to interest rates. The reaction from investors and analysts to this decision has been mixed, with stock indexes dipping and bond yields seeing a slight increase. This uncertainty underscores the delicate balance that the Fed must strike in its decision-making. Looking ahead, the Fed's future stance on rates will be shaped by a host of factors. These include the trajectory of inflation, global economic trends, and the overall health of the U.S. economy. The minutes suggest that the Fed is not ready to cut rates in this economic cycle, but they are also not ready to increase them. In addition to interest rates, the Fed is also considering the pace of reductions to its holdings of Treasury debt and mortgage-backed securities. Discussions on balance sheet issues are set to take place in the Federal Reserve's next meeting. As we wrap up our deep dive into the Federal Reserve's latest minutes, it's clear that the central bank's decisions have far-reaching implications. From the global economy to our personal finances, these decisions impact us all. As we continue to follow the developments, remember that every economic decision has a ripple effect, impacting not just the macroeconomy but also our everyday lives.